In China, property sector risk has come to a forefront at the onset of the mortgage boycotts on unfinished housing projects. China's debt to GDP ratio has surged from around 140% in 2007 to above 280% in 2022, according to our research. In our view, the debt-fueled, property-led growth model has to come to an end. The heavy-handed approach taken by the government can be seen as a supply-side restructuring of the fragmented property developer sector, similar to the supply-side reform in 2015. To beat the key industries into shape, we think the current crackdown on the fragmented property developer sector is akin to the squeezing out of the heavily indebted and inefficient coal miners, metal smelters, and so on. Our analysis found that the recent mortgage boycotts in China would not lead to a systemic collapse of the Chinese banking system. In our extreme bearish scenario with a massive default in boycotted mortgages, the potential non-performing loans would be increased by around 3.1 trillion RMB, or 1.5% of total loans in the system. It is still a noticeable amount, but not systemically detrimental. Non-performing loans from lending to property developers are also likely to rise, potentially by adding 1.3 trillion RMB. The impact is manageable, in our view, as such losses, if incurred, can be cushioned by the bank's existing 6 trillion RMB loan loss provisions and 20 trillion RMB of Tier 1 capital held as reserves. In our estimation, about 1.9 trillion RMB is possibly needed to complete all the stalled housing construction projects in China. The financial institutions owned by the central and local governments can help provide the needed financial resources to troubled developers or local governments to complete the unfinished projects, in our view. Unlike the US banks, Chinese banks do not offer subprime mortgage loans. They are also less levered with lower asset-to-equity multiples than the Japanese bank back in the 1980s. Through numerous tightening measures, the Chinese government has long been ring-fencing China's financial system from property sector risks since the 2010s. That said, we think Chinese banks would be much better cushions than their peers in the US and Japan in the event of further property sector weakness. Despite rising US rates in 2022, China has turned proactive in stabilizing the property sector by easing mortgage rates and relaxing administrative restrictions on home purchases to stabilize demand for properties.